Moving on now to more charitable strategies. There's this charitable remainder trust, which is the kind of the same idea as that Cupid where I was saying it's for a number of years and you get some benefit during the term of the trust before it goes to the remainder beneficiary. The charitable remainder trust is a way to put funds into the trust, get an upfront charitable deduction in the year that trust is funded, and then get income payments from that trust over the term of the trust. So you can have that for a fixed number of years, up to 20 years, or you can actually have the trust last for your lifetimes. If you're to set this up during your lifetime, you usually want to set this up with appreciated assets. So for those of you who have, a highly appreciated concentrated asset, you want to make sure you're liquidating it right away so you can get rid of that concentration without having to pay all the tax up front. A charitable remainder trust is a good way to do that. You put that highly appreciated asset in the trust. The trust is tax exempt, so it can sell the asset tax-free, and you get that charitable deduction up front. However, whenever you get those payments back from the trust over the terms, you get at least annual payments. That is when you're going to pay that capital gains tax. So you're not getting rid of the requirement to pay that capital gains tax in the sale. You're just spreading it out over a number of years, and you're avoiding it somewhat for whatever ends up going to that charity at the end of the trust term. So a charitable remainder trust can be set up a couple of ways. There's the unit trust, which is a percentage of the trust value based on a certain date every year. So if the trust value goes up, your unit trust payments go up. If the trust value drops, your unit trust payments will drop. So it'll fluctuate with the market and the value of the trust assets every year. And then there's a charitable remainder annuity trust where you get the same set payment every year. And as I said before, when those payments are made out to you, that's when you're paying that income tax on that sale of the asset that you did that first year. However, anything that goes to that charity at the end of the trust, since the charity is tax exempt, if there's anything left over, all the capital gains associated with what's left over then passes tax-free to the charity. I'm kind of talking about this as a strategy for during your lifetime, but you can also set this up for a strategy at death. So you can name who those unit trust or annuity trust beneficiaries are. They can be your kids. And so they can they can get an income stream over, say, 20 years and then get charity there. So it kind of allows you to set up an income stream for them instead of giving them, your beneficiaries, a lump sum up front. And the charitable trust is also going to be a very good strategy for IRA assets, because under the Secure Act now, your children probably have to liquidate those IRAs within 10 years and pay tax. If you put it into a charitable remainder unit trust with a 20-year term, now your beneficiaries are paying tax in the IRA over 20 years instead of 10 years. And then you're also giving a charity a benefit because they get whatever's left over at the end of those 20 years. And then again, here's a picture kind of how that charitable remainder trust works. So you transfer the assets into the trust sells them, reinvests them in however you want, and then pays an income stream back to you over the term of the trust or for your lifetime. And then at the end of the term of the trust or upon your death, anything that remains in that trust at that time goes tax-free to the charities. So that's why you get that charitable deduction up front, because there's some expectation that the charity is going to receive something at the end of the trust term.